Good afternoon. I'm Dr. Fasasi Kazim Adiola. This afternoon, we'll be looking at an important topic in Introduction to Financial Accounting. The topic is called double entry bookkeeping. Double entry is one major important aspect of financial accounting. The first thing is, what's double entry? Double entry can be defined as act of recording financial transaction twice as debit and credit entries in general ledger. What do we mean by this? Bookkeeping is art of recording financial transaction twice as debit and credit entries in the general ledger. The question remains, why debit and credit entries? Let's start from the word debit. Debit is a Latin word, and what this debit means is to receive. Credit is also a Latin word, and what it means is to give. And what does this mean? In every financial transaction, some party will be receiving and some party will be giving out. Those parties that are receiving, you have to record them on debit. Those parties that are giving out, you have to record them on credit. Meaning, in a single transaction, we have a receiving party, debit. We have party that is giving out, credit. This process is known as double entry. Record the transaction twice, one for the party receiving and one for the party giving out. The process of recording for party that is receiving, debit, and party that is giving is known as double entry. We have principle of double entry. And what are these principles? The principle of double entry, the principle of double entry stated that, in quotes, for every debit entry, comma, there must be a corresponding credit entry. This is the principle. For every debit entry, there must be a corresponding credit entry. What does this mean? It means for every receiver in business, there must be a giver. There must be a giver. What does this mean is that in every transaction, for you to have a receiver, you must also have a giver. The receiver is debit and the giver is credit. And for recording for a receiver, you must also record for a receiver, for a giver. For recording for a debit item, you must also record for a credit what? Item. That process is known as double entry. Let's put this double entry in a simple diagram for better understanding. What do I mean by a simple diagram? We have what we call transaction. And in every transaction, you have to bring out two accounts. These two accounts, one is record for receiver, is going to be what? Debited. And one is record for giver, is going to be credited. Meaning, the process of recording transaction in terms of double entry is that you will first identify two accounts in that transaction. In the two accounts that you identify, you record one for receiver and record the second one for giver. The process of recording the receiver on the debit and also recording the giver on the credit is what is known as double entry. Now, let's go in details. The first thing we are going to look at is we are going to be using one of the books of account to explain double entry. We'll start with what is a ledger. A ledger is principal book of account. Principal book of account where transactions are recorded permanently. Where transactions are recorded permanently. Now, this ledger we are talking about, we use it to record transaction permanently. And how does ledger look like? In practice, a ledger is divided into two folds. It has debit, DR, it has credit, CR. Data ledger has a column for date. It has a column for particular. It has a column for folio. And it has a column for amount. On the credit side, it also has a column for date. It has column for particular. It has column for folio. And it has column for amount. This is format of a ledger. Now, this ledger, when an item is being received, when you are receiving an item, you record it on the debit side. When an item is given out in your business, you record it on credit side. For example, if you sold an item out, that item is going out, you put the record on credit side. And for example, if you bought an item, you are receiving that item, you record it on debit. Now, each of the column has meaning. Date stand for the date the transaction started. Particular means what really happened in that transaction. Folio are for reference number. For example, you can have a customer who bears the same surname, the same middle name, and the same last name. If we have two customers who bear the same surname, middle name, and last name, the one we use to differentiate between the two customers is the source document. For example, receipt. The receipt has a serial number. It means even if they have the same name, they cannot be given the same serial number of source document, which is the receipt. The number on the receipt differentiates the first customer from the second customer, even if they bear the same name. In that case, the folio column is used for the number on the receipt. It means if you have a ledger and We want to record for a customer. On the folio, we are going to record the reference number on the receipt on the folio. This makes it differentiate first customer for second customer. And the amount of goods bought or sold is recorded under the amount. Also, we have other ledgers format that we can use to explain ledger. And what are these other formats? We have the one we call the T format. The T format is like this: debit and credit. Let's say sales account. The T format has a debit side and a credit side. The only difference is that there is invisible column. But how are we going to know there's a column? Sales means you are giving your goods out. Let's see this as example. January 1st, that's the date. The goods sold, they collected cash. That cash stands for particular. And what does it mean? It means the goods that is sold out, cash has been collected. And in classroom, we don't use the folio column. But to show that there's amount, you put a naira and put 5,000 naira. This is a format of a sales ledger using the T format. Now, let's go practical. We are going to look at some basic terms in double entry. We have what we call basic terms for beginners that are learning double entry. Basic term in double entry. What are these basic terms? We have what we call accounting terms here. What are the basic terms? The basic term is this. In accounting, if we have the word started or the word commence, when you are solving the accounting question, instead of you to write started, what you are going to write is capital account. When you see the word started, you write capital account in your solution. 2, if you see a word like this in your question, this is bought goods. What bought goods mean is purchases account. Also, if you see the word sold goods, what sold goods means is a sales account. If we give you word like check, in your solution, you will not write check, you will write bank account. If we now give you word like withdraw for personal use, withdrew for personal use. Look at the word I underline. Anytime you see the word personal use, what you are going to write in your solution will be drawings account. In that case, let's look at it. Anytime in a question you see the word started, what accountants are telling you is that you should solve it as capital account. When you have the word bought goods, what accountant is telling you is to write purchases account. If you see the word sold goods, what accountant is telling you is to write sales account. If you see the word check, what accountant is telling you is to write bank account. And if you see the word withdraw for personal use means drawings account. The next thing we are going to be looking at is how to identify account. Identification of account. We'll be looking at example by example. For instance, let's look at example 1. Example 1, let's assume we have January 1st. Started business by cash. This is a transaction. Now, the first thing you do is to identify two accounts from this transaction. How do you identify? One, you have identified one. You have identified one. Started, you have identified capital accounts. Started by what? By cash. The second account you have identified is cash account. That's the first thing you do. The second thing in your mind should be, out of these two accounts, which one is debit and which one is credit? For example, when you start a new business, what it means is this: you are injecting cash into the business. And all accounting records are strictly for the business and not for the owner, for business entity concept. That transaction should be clearly recorded for the business and not for the owner of the business. It means if you have started business by cash, who introduced this cash into the business is the owner. It means what the business receive is the cash. In that case, the cash will be debited, which means that that is what the business receive. Let's look at it this way. This is the business entity. What the business receive from the owner is cash and is going to be debited. And for every debit entry, there must be a corresponding credit entry. The credit entry means the capital. The capital is representing the owner. The owner is giving out. And if this capital is representing the owner, is giving out this money to the business. Now, if the owner is giving out, what represents the owner is what? Capital. In that case, capital will be credit. That's why we said for every debit entry, there must be a corresponding credit entry. What the business receive is cash. Receiving it from who? From the owner. And the owner is being represented by the capital. Now, the owner is giving out credit. What represents the owner is capital. In that case, capital account is credit. What does the business receive? Cash, debit. Meaning a new business, the business will receive cash, debit. While capital is the other item that is going out, credit. And why do we say capital is going out? It's because the capital is represented by the owner. The capital is representing the owner. And for the owner to commence a new business, he has to give money what? Out. He will credit the owner, and the business that receives the cash will be debited. This is the first example. Let's look at another example. We said example 2. Let's say January 5. Bought goods by cash. Solution: bought goods. You have identified one account. That's purchases. This goods is meant for sales. What they use to buy the goods is cash. The second account you have identified is cash account. Now the next question is this: see yourself as the business, bought goods. If you are buying goods into your business, you are receiving goods. For receiving goods, debit purchases. As you have debited purchases for receiving goods, in that business, what was given out to acquire these goods is cash. It means this time the business is giving out cash. Cash will be what? Credited. They are giving out their cash. The business is giving out cash. Credit cash. What did they receive? Purchases. What is standing for purchases is what? Goods. That's debit purchases account. This is the second example. Bought goods by cash. Debit purchases, credit cash. Let's look at the third example. The third example will be, let's say January 10, bought motor van by check. Now, what's the solution to this? The first time, when we say bought goods, we call it purchases. Some students might also call these purchases. Is wrong. The reason is this: in the last example, when we say bought goods means goods that are meant to be sold. That's why we call that purchases. But this is bought motor van. The motor van is not bought to be sold. It's bought to be what? Used. In that case, this will not be purchases. This will rather be what? Motor van. What do you use to buy the motor van? Check. In that case, the second account will be bank account. And this is motor van account. Now, what do you acquire? You acquire motor van. Debit what the business received, motor van. Credit what the business is giving out. In that case, we look at the last example. And the last example is example 4, January 15, sold goods on credit to Ayo. Sold goods here is one account, and that is sales account. And the second account is the person they sold to, which is Ayo account. This person they sold to is their customer and is on credit. This is what we also call receivable. Receivable what? Account. What are they selling out? They are selling out goods. And we have said this is the rules and the doctrine. Any item that is going out will be credited. If we say sold goods, it means the business is giving goods out. In that case, sales will be credited. The goods that is going out, we receive it. Ayo. Ayo will be what? Debited. In that case, these are little example on double what? Entry. We would like our viewers to provide solution to this more illustration I want to put on the board on the identification of account. Let's put something like this. We want our viewers, our students, to identify this more account. Identify question. Identify the following account. January 1st, commence business by check. January 3rd, bought furniture by cash. January 5th, bought goods on credit from Ade. And January 31st, paid salaries by cash. Thank you. We'll be looking at the practical aspect of the double entry in our next video.